Hi, I'm Jeff Reeves. I'm the editor of InvestorPlace.com. I'm talking with Jeff DeMaso, the co-editor of the independent advisor for Vanguard Investors, and Jim Lowell, the editor of Fidelity Investor. Guys, there's been a huge surge in ETFs over the last several years, and I think a lot of investors see them and they're kind of mystified by them. They think it's a great opportunity. Jeff, you actually gave a really interesting presentation at the Money Show about how some of the returns that you see in ETFs may not be exactly what you think they are. Can you tell me a little about that?
Yeah, exactly. It's kind of this trust but verify. So a lot of, I'm going to talk about what Vanguard does, but it's pretty standard practice within the industry. But if you go on Vanguard.com, you're going to see performance reported two different ways for their ETFs. There's NAV performance. And NAVs, like with a mutual fund, just what you get at the end of the day. But ETFs trade throughout the day, so there's also a market price. And Vanguard calls their market price the midpoint between the bid and the ask. So the NAV price and this kind of midpoint number are actually kind of a bit fictitious, as in a real investor can't buy and sell ETFs at those two prices. So that's the performance you're going to see on Vanguard.com. But if you own all 67 Vanguard ETFs like Dan and I do, you're going to see a different performance in your statement than what you see online. And actually, those differences can be pretty meaningful. And times are even bigger than the difference you see in expense ratios between ETFs and mutual funds. So sometimes those kind of trust but verify performance differences can overwhelm maybe your first argument into going into ETFs at all.
Jim, some Fidelity investors might be confused also by the fact that there's so many options that they can get from Fidelity. Different sector funds, you can slice up your portfolio in many ways. When it comes time to actually managing your money, it can insert a little bit of confusion into the equation, can it?
Oh, no question about it. They have hundreds upon hundreds of funds. They also just launched several sector ETFs last year and 3 actively managed bond fund ETFs this year. Everybody says Fidelity's late to the ETF party. The reality is I think they sort of stepped aside about a decade ago. It was a management decision. They saw that it was going to enter into a price war, basically an unflattering price war, and they wanted to see which businesses were going to be left standing. I think what they overlooked was the fact that $1 trillion was going somewhere and it didn't go to Fidelity. Now they're getting back into the game. Their sector funds, their sector ETFs are very different. Sector ETFs are passive to an MSCI benchmark. I prefer their actively managed select funds. But their actively managed bond funds are clone replicas. Same manager, same holdings, same expense, but in a more efficient and tradable instrument. I think the wave of the future for Fidelity is going to be in the actively managed ETF space. Nobody's there in a real way that dominates that space, and it's really the only space left in the ETF field that makes sense.
Yeah, I mean, the passive part of the ETF field is very much dominated by Vanguard, right, Jeff? So they've attracted a lot of assets through this. What are some of the challenges that Vanguard runs into when it becomes synonymous with these kind of big passive funds that are out there that are cheap, that are easy, and investors think, why not just buy this one and hold on to it for the next 50 years? Kind of what problems can arise when investors embark on that philosophy?
Well, Vanguard would probably like you just to buy it and hold it for the next 50 years and not think about it. They'd be okay with that. To your point about confusion, actually at Vanguard, while we think of just, hey, they're simple, plain vanilla ETFs, they've got a lot of different options out there. Within the small cap space, they're going to have an ETF that looks at three different ETFs that look at different indexes. So there's going to be indexes from S&P, from Russell, from CRISP, Center of Securities Research Pricing at the Booth School. So there's a lot of confusion there already within, okay, I want small cap stocks. I made that decision. I want to use ETFs. Okay, now which one do I do? So the confusion isn't just within the active space. You can be just as confused within the ETFs as well.
So Jim, what's the simplest way for me to cut through that confusion? How do I just get in a small group of funds that makes sense for me as opposed to wading through thousands and thousands of prospectuses?
You subscribe to Fidelity Investor, of course, or to Jeff's newsletter as well.
We'll help cut through that confusion.
Yeah, that's our job.
And you recommend both funds and ETFs, mutual funds and ETFs in the newsletter?
Yeah, I've been writing about ETFs since 1996, so they're not new to me in any way, shape, or form. But Fidelity ETFs are new to the marketplace, and they do play a role in Fidelity Sector Investor, another newsletter that we provide.
So, Jeff, does it matter to me at the end of the day as an individual investor whether or not I get a Vanguard mutual fund or a Vanguard ETF? If I'm in the right fund with a good manager that gets good performance, is there actually a difference between the mutual fund and ETF in my portfolio?
At the end of the day, not really, particularly at Vanguard, where if you can get into the Admiral share class, which has a $10,000 minimum, the expense ratio are virtually identical between the ETF and the Admiral shares. So in essence, the only difference is how you trade it. With a mutual fund, you get the NAV at the end of the day and don't have to worry about it, or you're going to be trying to trade throughout the day and focusing on that. So for most people, it's not going to be too much of a difference.
ETFs feel like they're a better mousetrap. They're not. We are strong advocates
the TV
of active
tells me
managers.
they are. The TV has
and the
ads
growth
everywhere.
of assets is very attractive, and they certainly can play a role, and they can complement a good diversified portfolio of active managers. But for low cost, to be able to get the best brains in the business doing your stock and fixed income investing on your behalf day in, day out, I think that's priceless.
Well, thank you very much, guys, for cutting through some of that confusion on ETFs and mutual funds. We'll get to some more picks that investors can take to make some more money in 2015 on InvestorPlace.com.